welcome.
It is genuinely great to be here.
I was sitting up late last night with this massive stack of papers, the 2025 annual report and financial statements for OPET Petrolcülük S, and I had a bit of a moment.
Oh, yeah.
Usually when we decide to do a deep dive on a company that deals in commodities, fuel, oil, the stuff that literally powers the physical world, we expect the story to be pretty linear.
Right. It's a volume game.
Exactly. You know the drill. You buy the fuel, you sell the fuel, you make a razor-thin margin, and you go home.
It's the classic high-churn, low-margin business model. It's predictable, it's steady, and frankly, it can sometimes be a little boring to analyze.
But today, we are looking at something completely different. We are looking at a giant that is dancing in the middle of a hurricane.
That is a very dramatic way to put it, but honestly, it is not inaccurate at all.
I mean, think about the context here. We are unpacking the 2025 financials. The date today is February 5th, 2026. The dust has finally settled on the 2025 fiscal year. And what a year it was.
Huge year.
We are talking about a massive fuel distributor trying to navigate a hyperinflationary economy.
And that context changes absolutely everything. It changes how we read the numbers, it changes how we judge success, and it definitely changes how we look at cash.
Exactly. And I want to tease the central tension of this deep dive right up front for our listener, the learner. Because if you just glance at the headlines, you might miss the magic trick.
It's easy to miss.
We are looking at a company here that managed to triple, yes, literally triple its operating profit.
Which is an incredible feat in any environment.
But here is the kicker, and this is the part that made me reread the page 3 times. Their real revenue, when adjusted for inflation, actually dipped slightly.
And that's the paradox we need to solve today, isn't it?
Yeah.
How do you sell less in real money terms, but keep 3 times as much profit from your core operations?
It's a story of efficiency, it's a story of incredible cash generation, and you know what? It's a story of strategic partnerships.
It really is.
And just to be clear, our mission today is strictly for the retail investor. We are demystifying the complex accounting of OPET based on their 2025 annual report. We aren't Wall Street analysts here. We are curious learners trying to figure out what makes this engine run.
We want to understand the mechanics, not just the headlines. We are going to strip away the jargon where we can, or at least explain it so it makes sense. This report is dense with things like TMS 29 and deferred tax assets, and we need to translate that into plain English.
Absolutely. So here is our roadmap for the next hour. We're going to start by profiling the company. Who are they really? Then we will look at the sector and do a quick SWOT analysis to understand the battlefield.
Then the main event.
The meat and potatoes, the deep financial analysis. We'll look at that income statement, the balance sheet, the cash flow, and finally we'll look at the future outlook.
Sounds like a solid plan. Let's get into it.
Let's first get to know the company a little, because OPET isn't just a gas station you stop at for a sandwich. It's a corporate structure with a very, very interesting history.
It's a great place to start, because understanding the DNA of the company explains a lot of the financial decisions we see later on.
Okay, so it was founded back in 1992 by Fikret Bezturk. And the headquarters, just so we can visualize where this brain trust sits, is in Ataşehir, Istanbul. Specifically, Barbaros Mahallesi, Çilincik Sokak.
Right in the heart of the modern business district on the Asian side. It's a statement location.
It is. And while the HQ is in Istanbul, their physical footprint is everywhere. I was looking at the list of branches in the annual report. They list specific locations like Körfez, Giresun, Mersin, Marmara, Ereğli. These aren't just offices, these are terminals, the arteries of the business.
And that geographic spread is crucial for a logistics-heavy business like fuel distribution. You need to be where the demand is, and you need to be where the ports are. Giresun for the Black Sea, Mersin for the Mediterranean, Marmara, Ereğli for the industrial heartland.
So they have the whole country covered.
If you don't control the logistics, you bleed margin. Every kilometer you save in transport drops straight to the bottom line. Their footprint is a huge competitive advantage.
But the thing that always fascinates me about OPET is the ownership structure. I mean, it's rare to see something this balanced in the corporate world.
It is the power duo, as I like to call it. It is a 50-50 partnership, and it's rock solid.
Literally 50-50. You have the Öztürk Group holding exactly 50% via Regnum holding SO, and then you have the Kus Group holding the other 50%.
And if you break down the Kus side, it gets even more interesting. The biggest chunk is held by Tüpraş, the refinery giant, which holds about 41.67%. Then you have the Kus family members and other Kus entities like Zir holding the rest, but functionally, It is two giants shaking hands.
Okay, so why does that matter for an investor? Why is that better than just having one boss?
Well, a couple of reasons. First, stability. When you have two major conglomerates like Koos and Oster backing an entity, it provides a level of financial security and strategic depth that a standalone company might not have.
So they're well capitalized and well connected.
Extremely.
Mm.
But there's more. The governance has to be very consensus-driven. You can't just steamroll the other partner. It forces a certain discipline. You get the entrepreneurial spirit of the founders, the Öztürk side, combined with the institutional might of Turkey's largest industrial group, the Knas side. It's a very powerful combination.
Speaking of governance, let's look at the leadership. The annual report lists the OPET leader, which I assume is the CEO role, as Özgür Karamanzade.
Yes, and I love that the org chart uses the term leaders for the department heads. It feels modern, less hierarchical.
It does. You have Radovan Usar as the sales and marketing leader. Makes sense. Didem Kaman as the finance and admin leader. She's the one responsible for these numbers we're about to crunch.
A very important job, especially this year.
Then you have Burak Ulkan on supply and terminals, Orsun Yamak on investments, Erdemli on IT. And I like this one, Nazlı Gringunul as the human and culture leader.
It's a full stack of leadership covering every critical vertical. They're not missing a beat.
I noticed something really interesting in the org chart labels. They actually list the number of employees in each department, broken down by gender, I think. It says F, followed by a number.
Yes, that's what it looks like. It's an unusual level of transparency in an annual report, but it gives us a fascinating peek into the operational weight of the company.
For example, finance has F.115. Sales has F.2700. It gives you a sense of the weight of the workforce. Sales is huge, which makes sense for a distributor. You need boots on the ground.
Right, that's your front line.
But finance having 115 people, that shows you just how complex the accounting and administration is for a company this size.
Especially in an inflationary environment. We will get to TMS 29 soon, but let me tell you, inflation accounting is not a job for a spreadsheet and a calculator. It requires a small army to track the real value of every single transaction. 115 people in finance isn't bloat, it's necessary defense.
That's a great point. And looking at the names, Didem Kaman, Nazlı İrem Günül, Esa Demir, Shilan Karases, there is significant female representation in the leadership layers.
Which is always a positive indicator for a balanced corporate culture. It suggests they are tapping into the full talent pool, not just half of it.
Now, everyone wants to know, what do these executives get paid? The report actually gives us a number.
They do, yeah. It's under benefits provided to senior management, which includes the board members and key executives.
The note says this includes wages, attendance fees, and other benefits. But it doesn't break it down person by person. It just gives the total pool.
And that's pretty standard practice in Turkey. They report the lump sum. It allows shareholders to see the total cost of leadership without violating individual privacy. It creates transparency on the cost to the company, if not the income of the individual.
Okay, so that's the people. What is the actual business? I know gas stations, but be more specific.
Well, the core business is defined as the wholesale and retail sale, import, export, storage, and distribution of petroleum products.
So they buy it, they store it, they move it, and they sell it. The whole value chain.
Precisely. But they don't just do it alone. They have some very strategic subsidiaries and joint ventures that broaden their reach. This is where the story gets more complex and, honestly, more interesting. Let's list them out because these play a big role later in our analysis. First, THY-OPET, aviation fuel. A 50% stake.
Yeah.
This is a critical partnership with Turkish Airlines. Think about the sheer volume of fuel THY uses every single day. OPET is right there at the airport, fueling those planes.
A huge, stable customer locked in.
Exactly. Then you have OPET Fudge.
Lubricants, another 50% stake.
Right. And this is a whole different business. It's a high-margin, brand-driven business. We're talking motor oils, industrial lubricants. It's less about volume and more about brand loyalty and quality.
And then the interesting one, the one looking to the future. Watt Mobile Light.
Yeah, it is the electric vehicle charging play. They have a 24% stake there. It's a smaller piece of the pie right now, but it's the bet on the future. It's their foothold in the energy transition.
And I saw a mention of something called Tarkin Connection in the notes, or maybe I'm misremembering the brand ambassador.
The source mentions they are the leader in customer satisfaction and most liked brand. While the financial report focuses on the numbers, we know that their marketing, often involving high-profile campaigns with celebrities like Tarkin, has cemented them as a premium brand in the consumer's mind.
So that brand equity is a real thing.
It's a huge intangible asset, that drives the tangible numbers we're about to look at. People will literally drive past 2 other stations to go to an OPET.
Okay, so we have the profile. A joint venture giant with diversified interests in fuel, aviation, lubricants, and EV charging. Let's zoom out. What is the arena they are fighting in?
The sector is fuel distribution in Turkey.
Intense.
Extremely intense. It is a highly competitive environment. You have logistics challenges, massive storage costs, and a network of thousands of retail stations to manage. And the margins are generally tight because the product fuel is a commodity.
So how do you win in that kind of market?
You win on scale, you win on logistics efficiency, and you win on brand loyalty. And increasingly, you win by transitioning to mobility.
Mobility, not just fuel.
Exactly. That investment in Watt Mobilite isn't just a hobby. It's a signal that the sector is shifting from just selling gas to powering movement,
Right.
whether that's electrons or hydrocarbons. The winner will be the one who owns the customer relationship for the entire journey.
Let's look at their competitive position. They claim to be the most liked and preferred brand. Is that just marketing fluff, or is there data to back that up?
Well, looking at the volume growth, the data backs it up pretty strongly. Between 2024 and 2025, they saw an 11% increase in domestic sales quantity.
An 11% volume growth in a mature market like fuel distribution.
That is significant. That means they are taking market share from someone. In a market where everyone sells the same 95-octane gasoline, growing your volume by double digits is a massive achievement. It says your brand, your locations, and your service are winning.
Let's do a quick SWOT analysis to wrap up this section. Strengths, weaknesses, opportunities, threats. I'll start with strengths.
Go for it.
Strength number 1, and it's a big one, shareholder backing. You have Coase and Toothbrush. That is deep pockets and, crucially, supply security.
Unbeatable strength.
Strength number 2, cash generation. We will get to the numbers, but they generated 15.2 billion TL in operating cash flow. That is a fortress built of cash. And strength number 3, diversification. They aren't just cars, they are planes with SuccessesOPET and industrial machines with OPET Fuch.
I would agree with all of those. The cash generation in particular is just stunning. Now, for weaknesses, the glare in the room is the foreign currency position.
Yeah.
They have a net foreign currency short position of roughly negative 14.4 billion TL.
Ouch. So to put that in simple terms, if the lira weakens against the dollar, they lose money on paper.
They lose a lot of money. They are exposed to currency fluctuations significantly.
Yeah.
That's a structural weakness of the business model. You're buying oil in dollars and selling in lira, and that creates this fundamental mismatch.
Okay, opportunities.
Aviation is booming post-pandemic.
Right.
SuccessesOPET is profitable and growing. And the big one is the EV transition via Watt Mobilite. Even though it is losing money now, which we will discuss, it is the opportunity to own the infrastructure of the next 20 years.
You have to spend money to make money, I guess. And finally, threats.
The macro environment is the biggest one. High inflation. That's why we have to use this special TMS 29 accounting. And currency volatility. If the currency swings wildly, that unhedged short position can go from a weakness to a 5-alarm fire very quickly.
Okay, that sets the stage perfectly. We know the players, we know the game. Now we can move on to our analysis, the deep dive into the numbers themselves.
Let's do it. I'm ready.
Before we throw out a single number from this income statement, we have to address the elephant in the room. The audit report mentions inflation, muhasebesinin uygulanması inflation accounting, or TMS 29. What does this mean for the learner listening right now? We can't just skip this.
No, this is absolutely crucial context. If you don't understand this one concept, you can't understand the 2025 report. It's that important.
So break it down for us.
Basically, Turkey has been in a high inflation environment. If we just compared the lira from 2024 to the lira from 2025, it would be like comparing apples to oranges, because the money itself has lost a significant amount of its value. A lira in 2024 bought more than a lira in 2025.
So TMS 29 fixes that. It makes it an apples-to-apples comparison.
It tries to. What it does is it adjusts all the figures, both for 2025 and the comparative figures for 2024, to the purchasing power of the Turkish lira as of one single date, December 34, 2025.
So everything is measured with the same yardstick.
Exactly. So when we say revenue decrease, we mean in real terms. It's like saying you earned more lira on paper, but those lira buy less bread than they did last year.
That's an extremely helpful way to think about it. So for the rest of this conversation, when we look at increases or decreases, we're looking at real inflation-adjusted performance.
Correct. We're looking at the true economic reality, not just the nominal numbers.
All right, with that foundation laid, let's look at the income statement. Top line, revenue, or as they call it, hasalat.
For 2025, revenue came in at 457.9 billion TL.
That is a massive number. It's hard to even comprehend. Almost half a trillion lira. But let's compare it to 2024.
In 2024, the inflation-adjusted revenue was 478.8 billion TL.
So revenue actually dropped by about 4%.
It did, by about 20 billion TL in real terms.
Wait, hold on. This is the paradox we talked about at the start. We just said in the SWOT analysis that their sales volume, the amount of fuel they sold, increased by 11%. How do you sell 11% more stuff but make less real money?
That is the insidious nature of inflation and pricing dynamics. It's a fantastic question. It means that even though they moved more fuel, the price increases they were able to pass on to customers likely lagged behind the general inflation rate that was used for the accounting adjustment.
So they were running faster just to fall slightly behind.
That's a perfect way to put it. Or another possibility is that the product mix shifted to lower cost items.
Yeah.
But either way, it illustrates the incredible difficulty of operating in this environment. You can have a record year for volume and still see your real revenue decline.
That is fascinating. But here's the twist. Look at the gross profit.
This is where the story gets really good. Revenue went down, but gross profit went up. It jumped to 21.1 billion TL in 2025, up from 17.3 billion TL in 2024.
So they sold less in value but kept more of it. How is that possible?
It means their cost of sales dropped faster than their revenue did. This implies a few things. Maybe they had incredibly smart inventory management, buying fuel at lower prices and selling it after prices rose. Or perhaps their supply contract with Toothbrush gave them favorable terms.
So their gross profit margin improved significantly.
Drastically. They became much more profitable on every liter of fuel they sold, even if the total value of those liters, in real terms, went down.
And that flows down to the operating profit, İsas Faaliyet Karı. This is the number that jumped out at me.
It is the headline number of the report, in my opinion. Yeah. This is the one you circle in red ink. Operating profit hit 6.02 billion TL.
And in 2024, what was it?
It was only 2.05 billion TL.
So it tripled.
Yeah.
From 2 billion to 6 billion.
Basically, yes. 193% increase. In a year where real revenue dipped, they tripled the profit from their core business operations.
That is incredible efficiency. That tells me management tightened the screws on every single expense, managed the supply chain perfectly, and just ran a much leaner operation.
That's exactly what it says. This is what we call operational leverage. A small improvement in gross margin flowed all the way down through the income statement to a massive improvement in operating profit. It's a sign of a very well-managed company.
Okay, so if operating profit tripled, surely net profit tripled too, right? That seems logical.
You would think so, but finance is never that simple, is it?
Let's look at the net profit for the period, the bottom line.
Net profit came in at 3.39 billion TL for 2025.
In 2024?
It was 3.28 billion TL.
Operating profit goes up by 4 billion lira, but net profit is basically flat. 3.28 to 3.39 is a rounding error at this scale. What happened to all that money? Where did the billions go between the operating line and the bottom line?
Two big things ate it up. First, and simplest, is finance expenses. They paid out a whopping 6.65 billion TL in finance expenses. That's interest on loans, fees, and so on.
Okay, that's a big chunk.
But the second and more complex factor is the inflation accounting itself, specifically a line item below the operating profit.
I see a line item here called net monetary position gain. It's a positive 3.5 billion TL this year.
Yes, but look at last year. In 2024, that same line was a gain of 9.0 billion TL.
So that's a huge drop in that specific gain.
Exactly. In 2024, they had a massive paper gain from inflation accounting. Basically, inflation eroded the real value of their lira-denominated debts faster than their monetary assets, creating a big accounting gain. In 2025, that gain was much, much smaller.
So let me see if I get this. 2024's net profit was artificially propped up by this inflation math. But 2025's net profit is driven more by actual, real operational success.
You've nailed it. That is a critical distinction for an investor. 2025's profit is high-quality profit. It came from selling fuel efficiently, not from an accounting adjustment. The quality of their earnings has improved drastically, even if the bottom line number looks flat. The engine is cleaner, stronger, and more efficient.
That makes so much more sense now. Let's move to the balance sheet and cash flow. Because if profit is an opinion, cash is a fact.
And the facts here are, frankly, staggering.
Let's start with the most important line, cash and cash equivalents. What do we have?
Okay, get ready for this. At the end of 2024, they had 2.38 billion TL in cash.
Respectable.
At the end of 2025, 9.84 billion TL.
They quadrupled their cash pile from 2 billion to almost 10 billion lira.
They are sitting on a mountain of liquid cash.
Where did it come from? Did they sell a factory or issue a ton of stock?
No, that's the beautiful part. They generated it. Look at the cash flow statement, the line for cash flow from operating activities. They generated 15.2 billion TL from operations.
15 billion in a single year. They are literally printing cash from their operations this year.
It's a cash cow, an absolute cash-generating machine. And what's really interesting is how they manage their working capital to achieve this.
I noticed that. Let's look at trade payables versus receivables. This tells a story.
It really does. Trade receivables, that's money their customers owe them, is about 24.6 billion TL. But trade payables, the money they owe their suppliers, is 31.3 billion TL.
So they owe their suppliers about 7 billion lira more than their customers owe them.
And in this business, that is a position of incredible power. It means they are funding their operations using their suppliers' money. They collect cash from customers at the pump instantly, but they pay their main supplier, Petrolcülük, on terms, say, 30 or 60 days later.
So that difference, that float, effectively acts like a constant interest-free loan from their supply chain.
Exactly. It's the secret sauce of retail giants. You sell the candy bar today, get the cash today, but pay the candy company in 60 days. You get to use that cash in the meantime. And when you are dealing with billions of liters of fuel, that float becomes billions of lira.
Okay, let's talk debt. With all this cash, are they debt-free? It sounds like they should be.
No, far from it. And this is another smart strategic move. They actually increase their borrowing.
Really? Why would you borrow money when you have almost 10 billion sitting in the bank?
Let's look at the structure. Short-term bank loans are about 4.0 billion TL. That's normal operational stuff. But look at the long-term borrowings, specifically the line issued debt instruments. That jumped to 7.4 billion TL, up from 2.7 billion.
So they went out and issued bonds or something similar?
Yes, they locked in long-term debt.
Yeah.
Now think about this. In a high-inflation environment, if you can lock in a fixed interest rate that is lower than future inflation, borrowing is actually a very smart move. You're effectively paying back the debt later with cheaper money whose purchasing power has been eroded by inflation.
It's a classic inflation hedge. And having that cash buffer gives them immense resilience. What about the net debt picture when you factor in the cash?
That's where you see the real improvement. Net financial debt decreased significantly. It dropped from 11.2 billion TL down to 8.8 billion TL.
Well, because that cash balance grew so much.
Exactly. And their net debt to invested capital ratio, a key health metric, improved to 18.51%, down from over 22% the previous year.
So the company is deleveraging relative to its size. It is becoming financially healthier and less risky.
A stronger balance sheet, massive liquidity, and improving leverage ratios. For an investor, that's a very solid financial foundation to see.
Let's look at the other side of the balance sheet, equity. Total shareholders' equity is around 38.76 billion TL, but it's actually slightly down from last year's 38.96 billion.
Which is interesting, right? They made over 3 billion in profit, so why did equity go down?
My guess would be dividends or something else.
That's the most likely explanation. It suggests that despite the net profit, other comprehensive income items, like actuarial losses on pensions, maybe, or more likely, dividend payments to their two big shareholders, Öztürk and Kos, pulled the total equity down slightly. But it remains a very equity-rich company.
And paid-in capital is just 150 million TL. That seems tiny for a company this size.
That is just the historical nominal value. It's an accounting number that reflects the initial capital put in decades ago. It doesn't reflect the true scale of the business.
Yeah.
The real value is sitting in lines like retained earnings and inflation adjustments to equity. Don't let that small paid-in capital number fool you.
Okay, we've covered the mothership. Now let's look at the fleet. The subsidiaries and strategic investments.
Yeah.
This is where we see the diverse bets they are placing for the future.
Right. And they're not all the same. Let's start with the high flyer, SuccessesOPET.
The aviation fuel joint venture, what are the numbers there?
The revenue is huge, 34.8 billion TL.
Wow. That's a big business on its own.
And it made a net profit of 137 million TL. It's profitable, it's massive, and it's deeply strategic. As long as Turkish Airlines is flying, and they're always flying, OPET has a guaranteed high-volume customer. It acts as a stabilizer for the whole group.
Then we have the other 50-50 JV, OPET Fuch, lubricants.
Revenue of 5.9 billion TL. But here's a surprise. It posted a net loss of negative 124 million TL.
That's a swing. It was profitable before, wasn't it?
It seems so, yes. The notes indicate a swing from the previous year. This could be due to rising raw material costs. The price of base oils impacts lubricant margins heavily, or perhaps they're engaged in aggressive market positioning.
You mean like discounting to gain market share?
Potentially. It's a blemish on the overall report, but likely a temporary one given the strength of the Fuchs brand globally. It's something to watch, but not a panic button.
And now, the one I'm most curious about, what Mobilite? The EV charging company. The future bet.
This is the one everyone's watching. So revenue is growing. It hit 416 million TL, which is up nicely from 293 million TL the year before. The top line is moving in the right direction. People are using their chargers.
But the bottom line, what's the profit or loss?
The losses are widening. They lost 686 million TL.
Ouch. They lost more than their entire revenue for the year.
That is the burn rate of a startup phase investment. This is classic venture capital stuff. They are building out a massive network of charging stations, investing in software and technology, and spending on marketing to acquire customers. You expect to lose money, a lot of money, in the infrastructure build-out phase.
So they are bleeding cash in the EV business to build a moat for the future.
Exactly. And with OPET's main business generating $15 billion in cash, they can afford to fund this loss. It's a luxury that smaller, pure-play EV charging competitors don't have. They can play the long game.
That's a great point. The cash cow is funding the calf that they hope will one day be the new cash cow?
It's the classic BCG matrix strategy, right there in their financial statements. Use the cash cows to fund the stars, or in this case, the question marks.
Now, we have to talk about the things that keep the CFO awake at night. The risks section. We mentioned the Forex short position. Let's quantify the fear for the listener.
The note on foreign currency risk is stark. As we said, they have a net short position of about 14.4 billion TL.
What does the sensitivity analysis say? If the dollar jumps 10% against the lira, what happens to their profit?
The report is very clear on this. If the USD-TL rate changes by 10%, the impact on the profit and loss statement is nearly 1 billion TL.
So a 10% currency shock just casually wipes out 1 billion lira of profit?
Roughly, yes. Before tax, it's their single biggest financial vulnerability. They're operationally hedged to some extent because fuel prices in lira eventually adjust to the currency, but the balance sheet impact is immediate and painful. It's a roller coaster they're forced to ride every single day.
Then there's the related party transactions. We touched on this, but the scale is just mind-boggling.
Purchases from related parties totaled 231 billion TL.
And almost all of that is Tupras, their shareholder and supplier.
Yes, they buy their fuel from their partner. It's a closed loop.
And they owe them a lot of money, too. The report says trade payables to related parties is 13.3 billion TL.
Again, this shows the tight integration with the co-ecosystem. Now, you can look at this two ways. It's a risk in terms of dependency. They absolutely need Tupras. But it's also an incredible strength. Supply security is guaranteed. In a fuel crisis, OPET gets fuel when others might not.
So their fate is tied to Tupras' fate.
For better or for worse, yes.
The auditors also flagged some critical audit matters or comms. What were they most worried about when they were checking these books?
Two main things, which isn't surprising. First, revenue recognition. Because of the sheer volume and nature of fuel sales, billions of transactions, making sure every liter is accounted for correctly is incredibly complex. The auditors spend a lot of time testing those systems.
And the second, let me guess, inflation.
You got it. Inflation accounting, TMS 29. The auditors noted that they spent a huge amount of time testing the models, the indices, and the assumptions used to adjust all the numbers. The complexity of restating everything for hyperinflation was a key audit focus. It shows just how technically difficult this report was to produce.
Let's look at the management commentary and future outlook. They spent a lot of money this year, not just on operations.
They did. Total investment in 2025 was about 10.1 billion TL.
That is not a small amount of capital expenditure.
No. They are investing heavily in fixed assets. That means renovating their stations, building new terminals, and supporting the dealer network. They are not sitting on that cash. They are plowing a significant chunk of it back into the ground to maintain and expand their physical advantage.
And the outlook. What's the public-facing message?
They are laser-focused on maintaining that #1 position in customer satisfaction. They know that in the commodity market, the brand and the customer experience are the only real differentiators. If the gas is the same price everywhere, you go to the station with the cleaner bathroom and the better coffee.
And the sustainability piece. Is that just talk?
I don't think so. We saw the sustainability leader in the org chart. They're pushing hard on this, likely driven by the COSAS Group's wider sustainability goals. It's not just about the EV chargers. It's about reducing the carbon footprint of their logistics, managing waste at stations, all of it.
So let's synthesize all of this. We have been deep in the weeds for a while now. Let's come up for air. What is the final verdict on OPET in 2025?
OPET is a cash-generating machine. That is the headline. They navigated a hyperinflationary year where real revenue actually dipped, and they still managed to triple their operating efficiency. It's an incredible performance.
They tightened the belt and the profits just poured out.
Exactly. And the balance sheet is incredibly strong as a result. They have that massive cash buffer, almost 10 billion TL, which gives them tremendous optionality. They can pay dividends, they can acquire a competitor, or they can weather a serious economic storm.
But there are clouds on the horizon.
Of course. The Forex short position is a constant nagging threat, and the transition to EV is costly. Watt Mobilite is a drag on earnings right now, even if it is absolutely the right strategic move for the long term.
And the inflation environment creates so much noise in the numbers, you have to look past the net profit stability to see the operating profit explosion.
That is the key insight for you, the learner. Don't just look at the bottom line, look at the operating line. The core business is healthier and more profitable than the net income number would suggest.
It's a story of resilience, really.
It is. And it's a story of power. The power of the Coase and Osterk partnership, the power of the supply chain, and the power of that negative working capital cycle.
Before we wrap up, I want to leave our listener with a provocative thought. We talked about Watt Mobilite losing 686 million TL to build the future of EV charging. And we talked about the traditional fuel business generating 15 billion TL in cash.
The cash cow and the calf.
Here's my question for you, the learner, to think about. Is OPET essentially funding its own disruption? They are using massive petrol profits to build the very thing that might eventually replace their petrol stations.
It's the innovator's dilemma in real time.
Exactly. And the second part of the question is, in a high inflation world, is their strategy of holding massive cash reserves, that 10 billion TL, the safest bet, or is it a missed opportunity for investment? Should they be spending that cash faster before inflation eats away its value? Or is cash truly king when the market is this volatile?
That is the multi-billion lira question, isn't it? Funding your own disruption is brave, but holding cash in a high inflation environment is risky. It's a very delicate balancing act.
We would love to hear your thoughts on that. Drop a comment if you are watching this on a platform that allows it.
Or just mull it over. It's a fascinating strategic dilemma with no easy answer.
As always, if you enjoyed this deep dive and found it useful, please smash that like button. It really helps the channel out. And subscribe so you don't miss the next one.
And if you know someone who's trying to make sense of the market, share it with them.
And please evaluate joining our membership to support the channel and keep these deep dives coming. It takes a lot of coffee to get through these 100-page reports.
And you can also show your support directly via Super Thanks. We appreciate every single bit of it. It helps us keep the lights on.
Thanks for listening. We will see you in the next deep dive.
Goodbye.